Hello, this is Bennett Tchaikovsky, and welcome to Financial Statement Ratios. This is part one, Introduction and Liquidity Ratios. And my disclaimer and copyright notice, the information and opinions in this presentations are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This present is copyright 2019 by myself. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you do modify the presentation anyways, please email me prior to doing so, and there's my email address to discuss. I do not claim any copyright whatsoever in any companies or organizations mentioned in this presentation, which I call the other parties. Rather, those other parties are the owners of their respective copyrights. Before I start, I want to give a huge thank you to Investopedia, and I'm using a lot of their definitions, which again belong to them and their authors. Their concise definitions and videos, if you want to learn more, go to their website. It's a great one. I had a former IVC student who transferred to, that's Irvine Valley College, who transferred to UCLA, and she said that using Investopedia helped her get an investment banking job. So it's a really, really powerful website, and if you want to learn more about the market or any other kind of information, that's a great website to go to. Again, I'm not being paid at all by Investopedia, but because I'm using a lot of the information in my presentation from them, I'm giving them a huge shout out because they deserve it. So when we're looking at financial statement analysis, and this is really for financial and managerial accounting, the first thing we need to do is, and this is really when it comes down to ratios. Ratios can be helpful when we're comparing two similar companies in the same industry. And that's really important because if I start looking at a social media company like Facebook, and I'm trying to compare it to the Home Depot, those are two separate companies. Obviously, they are two separate companies, but they're in two completely different industries. So when I'm doing financial statement analysis, I really need to make sure that I'm selecting two companies that are in the same industry. And that way that the numbers will hopefully make a little bit more sense. The other part of this here is that numbers are not the end all, because when you're computing ratios, if a company has great numbers, that does not mean necessarily that the companies are great. You have to look at both the quantitative analysis, which is really the ratio analysis, and also the qualitative analysis. And what I mean by qualitative analysis, who is involved with the company. And to find out more about people or whoever you're going through and dealing with, I want to encourage you to go to finra.org. And finra.org is where you can find anybody who is a licensed broker. And if they have any kind of background or any other kind of history or complaints against them, also want to go have you take a look at sec.gov. It's, again, I have other videos posted. It's a great website to learn more about specific individuals or companies. If a company is listed on the NASDAQ or the NYSE, before they go ahead and uplist, the NASDAQ and the NYSE at a minimum are going to be doing full background checks on the officers and directors of the companies. That's something that's really kind of hard for you to do as an individual, is to do that background check unless you're friends with our Russian friend or wherever he is now, Mr. Snowden. But when we look here at NASDAQ, if you see a company on the NASDAQ and NYSE, they're essentially, their listings department has generally gone through and vetted out a lot of the executives. Now, if a company is listed on the over-the-counter bulletin board or the QB, which is the higher one, they also may have gone through some vetting. But most of the times, most companies, most board of directors, at least of publicly traded companies, will do a pretty thorough search on their board members as well as their executive officers. So the other thing in terms of qualitative analysis is who is the investor relations, public relations firm. This is when you're looking at smaller cap companies, you want to take a look at who is the investor relations firm that they're using. Is it a former broker gone bad? What's happening there? And also who is doing their public relations, who's responsible, and who are those individuals that are doing the outside of it. Investor relations is really how a company is going through and communicating with its investors and giving investors information about the company, whereas public relations is more about how is information getting out about the company to the general public. They sometimes kind of work with each other together, but again, it's kind of important to know who you're dealing with. And then lastly, the background of other investors. If you see an investor that's going into a particular company, and if they have a sordid history or if there's something else going on there, you want to see who they are. I'll never forget one of the mistakes I made in my career was that when a company that I was working with, they were being acquired. And one of my attorneys advised me, he said, "Oh, Bennett, all you need to see is a check." But that's not really the case. You need to look at, if you're getting money from somebody, who is it exactly that you're getting the money from? And that's especially in terms of for fundraising. But again, the qualitative analysis side is really looking at the surroundings of the company that you're going through and dealing with. And I'm just listing this here because I don't want you just to be looking at the numbers alone when you're doing financial statement analysis. So we have our first set of ratios, and I've split up this presentation into 4 different parts for the areas of the different types of ratios. The first type of ratio is the liquidity ratio. And per Investopedia, liquidity ratios are a class of financial metrics used to determine a debtor's ability to pay off current debt obligations without raising external capital. Notice here the word current. Okay, this is really important because when we look at these ratios that deal with liquidity, we're only looking at really current assets and current liabilities. What are current assets? It's any asset that we're expecting to be using in the coming year. What are current liabilities? Obligations that we have to pay in the coming year. So the working capital is our current assets minus current liabilities. Current ratio is current assets divided by current liabilities. The quick ratio is our very liquid current assets, which are cash, marketable securities, and current receivables, all divided by current liabilities. Now, what's the difference between current and quick? Generally, current will include a current asset such as inventory if we're planning on selling that within the next year. For these ratios, generally the greater the results are, the better. So you want them to be higher because you have better coverage. Okay, so when we're looking at these ratios, what I decided to do was to go through and choose 3 companies. I chose Home Depot and Lowe's because they're generally in the same industry. But I also chose Facebook. And Facebook doesn't really compare to those 2 companies, but I think it can give you some perspective in terms of when we're going through and analyzing companies. So let's take a look here. So for our first ratio, which is the working capital ratio, we have here, we've got Home Depot, which is really going up here. We've got Home Depot, we've got Lowe's, and then we've got Facebook. The first asset, or the first one we're going to do, is we're going to do the current, we're going to do working capital. What is the total working capital of each of these companies? For Home Depot, I took their most recently issued quarterly report, which was October 28, 2018. Their annual results should be out probably sometime in February or maybe March. But if I look here of my current assets, Home Depot has $19,809,000,000 of current assets, and they have current liabilities of $18,196,000,000. So their total working capital is 1.6 billion. If I look at if I look at Lowe's, Lowe's here has total assets of, total current assets of 15,138,000,000, total current liabilities of 15,069,000,000, and they only have working capital of $69 million for the quarter as of November 2nd, 2018. And lastly, I'm going to look at Facebook. And when I look here at Facebook, oh, Tchaikovsky, you slipped up. Let's do this right here real quick. And if I go to Facebook's quarterly report, and I have another video published on this playlist, which shows you how to look up publicly traded companies. Facebook has total current assets of 49 billion, and they have current liabilities of 5.4 billion. So their working capital is $43 billion. So when we look at these three companies, and again, when my students see this, they always kind of ask me the question, well, is 1.6 billion a good number? And the answer is, honestly, one number is not going to tell you everything that you need to know about the company. And when I look at Home Depot in particular, what's very misleading about this number is Home Depot as a company. If you look at their owner's equity, and this is what's pretty wild, their owner's equity, they've got total assets of 45.2 billion. They have total liabilities of 43.8 billion, but they only have equity of 1.3 billion. That's very misleading, because what Home Depot has been doing over a long period of time is they have been repurchasing their shares like crazy. And so they have invested in themselves, meaning that they've bought on the open market. They've taken their earnings and they've been repurchasing their own stock. They've bought back $53.6 billion of their own stock as of October 28th, 2018. Now, when you buy your own stock, you would almost think, well, I'm debiting treasury stock and I'm crediting cash. I can't show my own stock as an asset. If I could, this number would not be $45 billion. This number would be about $98 billion. But because when I repurchase my own shares, I have to include it as a reduction of my owner's equity, then this is why their numbers look kind of funky. So again, when you're looking at these ratios, be very mindful that this may not be the only thing that's happening here. Rather, it's, there could be a lot of different variants. Over here for Lowe's, Lowe's is a little bit more of a straightforward company. Lowe's really hasn't gone through and, Lowe's really hasn't gone through and they have not really repurchased any of their own shares. So if we go ahead, then let's go back in here and look at the ratios. So look at the working capital. Clearly, of these three companies, Facebook has a great amount of money to, work with. But if I looked at Home Depot and if they were to go out and resell all their repurchase shares tomorrow, theoretically, this number would jump very much higher. So again, that's the working capital ratio. It tells us, well, what do we have to actually put into use as far as our business goes? The next one here is our current ratio. And notice here, I'm not going to really conclude about any of these companies. And really, for me to do that, I would need to go through all of the various different ratios to really do a full analysis and then really kind of see, well, what's their business plan and how do I make sense of these numbers? This video is to really show you how to go through and compute the various different ratios so that can help you for whatever projects you have as far as in school or in work or going forward. So the next ratio I want to look at is the current ratio, or what are my current assets to my current liabilities? Like kind of what's my, what's going to be my ability to go through and pay those. So what we're really doing with the current ratio is we're taking the two elements of the working capital, ratio, and we're just dividing them in. So here I've got a ratio of 1. For Lowe's, it's a ratio of 1. And Facebook, it's a ratio of 9. What does that mean? Well, you know, their current, if the number, I want this number generally to be higher, because the higher the number is, the more ability I have to pay my current liabilities if I'm just looking at this ratio in isolation. So here with Facebook, they clearly have the best ratio because, again, their current assets are about 49 billion and their current liabilities are 5.4 billion. So their current ratio is about 9. If I was a creditor and looking at these ratios, and this is, or if I was planning on either loaning money or doing business with one of these companies, this would be something I would want to be looking at, because how liquid is this company? How quickly are they going to be going through and paying me back? The next ratio we're going to look at is something called the quick ratio. What is the difference between the quick ratio and the current ratio? Well, the quick ratio, or what we call the acid test ratio, only takes the most liquid amounts that are on the balance sheet and then goes through and considers those for basically for the calculation. And as I'm looking at this right now, I just realized I made a mistake, so we're going to go ahead and correct that. We'll do it first for Home Depot. Notice the current liabilities aren't changing as of October 28th, 2018. But for Home Depot, cash was right here was cash and cash equivalents were $1,764,000,000. The receivables were $2.1 billion. Home Depot does not have any investments in short-term securities, so we're just going to move this down. And when I'm looking here at current receivables, I'm just going to assume that the receivables here for Home Depot are current. So when I look at a quick ratio, this shows me that, well, wait a second, it went from 1 down to 0.21. So what is this huge difference? Well, in the current assets of Home Depot has $14.7 billion in merchandise inventory, or inventory that it's reselling at its stores. So if we had to go through and liquidate our assets very, very quickly, I would really only have, you know, the cash, and theoretically, I would only have the cash and cash equivalents and the receivables net. So what I have to remember is that Home Depot has other ways in terms of financing. They're able to raise debt or the like. So it's really one of those things that, as I'm looking here at Home Depot, the quick ratio, even though it doesn't look wonderful, is somewhat misleading because they have other ways of getting financing through. Again, Home Depot is unique. They've repurchased a lot of their own shares, and that's kind of why their numbers are a little bit funky. So I go now to Lowe's, and Lowe's right here had cash of $1.6 billion, marketable securities of $85 million, and so their total quick assets are listed here as about $1.7 billion. Notice I'm excluding other assets. I'm just assuming that nothing's really there. So here I have Lowe's companies, and here for Lowe's, they have that's the cash and cash equivalents, the short-term investments. And so right here, whoa, did I screw that up? Good job, Tchaikovsky. 1668 and then 208. Wow. Okay, I'm losing it. So here, there we go. So for Lowe's, their quick ratio is about 0.12, meaning that their current liabilities exceed their cash, marketable securities, and current receivables pretty significantly. So right over here for Lowe's, you have, again, with Lowe's, they have long-term debt, or essentially they have got, looks like they have borrowing abilities here. But again, for Lowe's, a lot of their current assets are right here in terms of merchandise inventory. So Lowe's, and they've got about accounts payable of about $9.2 billion. So for Lowe's, this becomes, in terms of looking at the quick ratio, you would want to just kind of make sure, do they have the ability to go out and raise more money? Which I'm sure that they do, because they've got about $4.4 billion in terms of long-term debt. But if I was a vendor selling to Lowe's, I would really want to make sure that I'm actually going to be getting paid timely. And it's just because when I look at the quick ratio and how large their accounts payable balance is, that's something I would at least want to go through and explore a little bit more. Lastly, here, I've got Facebook. And Facebook over here, Facebook has, so Facebook has current assets right here of 9.6 billion, marketable securities of 31.5 billion, and accounts receivable of about $6 billion. This prepaid expense and other current asset is the only item that I'm really excluding. I'm assuming that all their receivables here are current. So when we look at the quick ratio for Facebook, you see a drop off, but it's pretty insignificant compared to these drop offs here. And again, why is the drop off so huge for Lowe's and Home Depot? They carry inventory. Facebook does not carry inventory. It's not that it's not that type of a company. Their social media, they don't carry inventory. So this is really this is really the difference. And this is why when you look at ratios, you have to go through and see what's really relevant. And that's why when you're choosing ratios, you have to make sure that you're looking at the same industry, because industry to industry, you're going to have different types of ratios going through. So this is the end of this segment here on liquidity ratios. Please do not forget to like, share, and subscribe. I'm trying to get my sons to be excited about the fact that I'm getting more views and likes than his Fortnite videos that he's watching constantly. And if you have any feedback or comments, or if you want to if you got any questions, please send me an email at 1812cpa@gmail.com, or the one mentioned in the presentation earlier. Thank you so much and have a great day.